If you own gold or silver, what I'm about to show you matters more than today's price candle, because this isn't about a $2 dip. This isn't about a $5 spike. This is about what just changed inside the plumbing of the LBMA and COMEX, and why almost nobody in mainstream finance is explaining what it actually means. Stop looking at the chart for a second. Look at the structure, because when exchanges start adjusting rules, inventories, margin requirements, or reporting frameworks, that's not cosmetic, that's stress management. And stress inside the paper metals market is the one thing the public is always the last to hear about. Let's slow this down. The LBMA and COMEX are not just marketplaces. They are the backbone of global price discovery for gold and silver. The LBMA dominates the London over-the-counter physical market. COMEX dominates U.S. futures pricing. When those two hubs shift behavior, and whether it's inventory reclassification, delivery mechanics, position limits, or margin changes, it tells you something about supply, demand, or risk tolerance inside the system. And what just happened, it wasn't loud, it wasn't dramatic, but it was significant. Because we're seeing tightening signals at the same time volatility is increasing, and that combination doesn't happen in healthy surplus conditions. Now let me make something clear. This is not about panic. It's about pressure. Paper metals markets function smoothly as long as most contracts are rolled, not delivered, as long as participants trust settlement, as long as inventories look adequate, as long as margin models remain comfortable. But when you start seeing increased attention on registered stocks versus eligible stocks, delivery notices clustering, or open interest staying elevated into delivery months, that's not random. That's participants testing the system. Let's talk COMEX first. COMEX operates on a warehouse reporting system. There's eligible metal, which meets exchange standards but is not necessarily available for delivery. And there's registered metal, which is actually available to settle futures contracts. Most retail investors never look at that distinction, but institutions do. Because if open interest represents claims on far more metal than is registered for delivery, the system relies on confidence that most contracts will cash, settle, or roll. Confidence is the lubricant. Now imagine registered inventories declining while open interest remains strong. That doesn't mean default. It means tension. It means more claims per ounce. And tension inside leveraged future systems increases volatility potential. Now let's connect LBMA. The LBMA clears enormous daily volumes in unallocated gold and silver accounts. Unallocated means you have a claim, not specific bars. Allocated means specific bars are set aside. Most institutional trading happens in unallocated form. Again, confidence-based. As long as clients don't demand allocation en masse, the system functions smoothly. But when global macro uncertainty rises, central banks accumulate, and geopolitical tensions increase, you sometimes see more demand for physical allocation. That's not collapse, that's preference shift. And preference shifts change market behavior. Now ask yourself something critical. Why are we seeing inventory focus, rule scrutiny, and reporting attention at the same time macro uncertainty is rising globally? Energy markets volatile, debt markets strained, central banks navigating policy traps, geopolitical friction increasing. In that environment, gold and silver are not just commodities. They are collateral. They are reserves. They are hedges. When assets become collateral in uncertain times, their underlying market structure matters more. Now here's where it gets interesting. If delivery demand increases modestly, the system absorbs it. If delivery demand increases sharply, margin requirements rise. Why? Because exchanges protect clearinghouses first. Margin is a risk control lever. When volatility increases or delivery pressure rises, margin requirements adjust. Higher margin means leveraged longs and shorts both face pressure. That can trigger liquidations. Liquidations create volatility. Volatility attracts attention, and attention brings new participants. This is how quiet structural changes become loud price moves, not overnight, but in waves. Now let's address something directly. Every time someone mentions COMEX and LBMA in the same sentence, emotions run high. People jump to default scenarios. That's not what this is. This is about stress signals. Markets don't fail overnight. They show strain first. Strain shows up in inventory flows, margin adjustments, delivery patterns, reporting changes, and right now we are seeing enough movement inside those categories to pay attention. Now let's zoom out. Global central banks have been net buyers of gold for years. That's not speculation, that's reserve diversification. At the same time, sovereign debt globally has expanded. Real yields fluctuate. Currency trust ebbs and flows. Gold functions as neutral reserve collateral in that environment. Silver functions as both monetary hedge and industrial input. So if physical preference increases even slightly and inventories are not expanding proportionally, price elasticity increases. Elasticity means faster moves. Now layer in geopolitics. When geopolitical tension rises, safe haven flows increase. If those flows target metals at the same time, inventories are tighter than usual. Paper leverage amplifies moves. That amplification can be upward or downward initially, but it increases range, and range is opportunity or risk, depending on positioning. Now here's what most retail misses. Price discovery in gold and silver is heavily futures-driven short-term, but physical flows influence medium-term trend. If physical tightness persists beneath paper volatility, dips get absorbed. If physical tightness accelerates, resistance levels break. That's the dynamic to watch. Not just spot price, structure. Now imagine this scenario. Open interest remains elevated into delivery month. Registered inventories are lower relative to claims. Geopolitical uncertainty increases. Central bank buying continues. Margin requirements adjust slightly higher. Volatility picks up. Silver approaches a psychological level like $100. Gold approaches new nominal highs. At that moment, breakout mechanics matter, because if physical demand underpins futures pressure, breakouts sustain. If physical demand fades, breakouts fail. That's the balance. Now here's the huge update part. We are entering a phase where paper positioning and physical preference are converging. That convergence doesn't guarantee direction. It guarantees movement. And movement in metals tends to be underestimated until it's obvious. Think back historically. Metals don't grind upward politely forever. They consolidate, they compress, then they expand. Expansion phases catch people off guard because they look slow until they aren't, and structural stress accelerates expansion. Now let's talk silver specifically. Silver's futures market is thinner than gold's. That means less capital is required to move price. If delivery attention increases or industrial buyers step in during volatility, the reaction can be outsized. Add in algorithmic trading that triggers on breakout levels and you get acceleration. Acceleration is what breaks ceilings, and when ceilings break, narrative shifts. Narrative shifts attract capital. Capital fuels continuation. This is reflexivity. Now here's the part you need to internalize. Owning gold and silver in this environment is not about predicting collapse, it's about recognizing asymmetry. Downside risk in physical metals is bounded by production cost floors and central bank interest. Upside potential during macro stress is nonlinear. When structural updates emerge from LBMA and COMEX, they are not guarantees. They are signals. Signals that the system is active, signals that positioning matters, signals that volatility windows may widen. And widening volatility windows into macro uncertainty is exactly how triple-digit silver and new gold highs become plausible faster than expected. So what should you actually watch? Watch registered versus eligible stocks. Watch open interest into delivery. Watch margin announcements. Watch central bank reserve reports. Watch physical premiums in retail markets. Those are the pressure gauges, not Twitter, not headlines, not emotional commentary. Structure. Because structure tells you whether dips are distribution or whether dips are absorption. And absorption under stress is bullish. Now step back one more time. This is not about drama. It's about alignment. Macro tension rising, energy uncertainty present, debt levels elevated, central banks active, paper leverage high, physical preference increasing, LBMA and COMEX activity drawing attention. Alignment of forces creates potential energy. Potential energy releases eventually. The only question is timing, and timing in metals is rarely polite. If you own gold and silver, this is not the time to stare at daily candles in isolation. It's the time to watch the plumbing. Because when plumbing tightens under pressure, price doesn't whisper. It moves. And when it moves, it doesn't ask whether you were comfortable. It just reprices. The huge update is not a headline. It's a shift in tone inside the system. And tone shifts precede regime shifts. If you understand that, you won't react emotionally to volatility. You'll recognize it as part of a structural buildup. And structural buildups in metals have historically ended one way, with expansion, not drift. Watch closely. Because when LBMA and COMEX start flashing subtle signals at the same time macro risk rises, that's not coincidence. That's compression. And compression in gold and silver is rarely quiet for long. Because if you think the story ends at inventories are shifting and watch registered stocks, you're still only seeing the surface layer. Let's go deeper into why this LBMA and COMEX update actually matters in the broader macro cycle. Because metals don't move in isolation. They move when confidence shifts. And confidence is the real variable here. Paper metals markets operate on trust. Trust that contracts can settle. Trust that liquidity will remain. Trust that counterparties will perform. Trust that leverage ratios won't be stress tested simultaneously. Most of the time, that trust is justified. But when macro uncertainty rises, participants subtly change behavior. They don't announce it, they adjust it. Less unallocated exposure, more allocated preference, slightly earlier delivery, slightly higher margin cushions. Those small adjustments ripple through a leverage system. Now let's talk about leverage. COMEX futures allow enormous notional exposure relative to actual physical supply. That's not scandalous. It's how derivatives markets function. The vast majority of contracts are never intended for delivery. They are hedges, speculation, arbitrage, liquidity tools. But the system works because only a small percentage stands for physical. If that percentage rises even modestly during volatile macro conditions, strain increases, not collapse. Strain shows up as tighter spreads, higher margin, faster price reactions, shorter consolidation periods, and more violent breakouts. Now zoom out and connect this to what's happening globally. Central banks are still accumulating gold. That tells you something about long-term trust dynamics. They're not buying because they expect next week's volatility. They're buying because of long-term reserve diversification. That structural bid underpins gold. Silver doesn't get the same central bank attention, but it gets industrial attention. And industrial demand is less emotional. Factories don't care about Twitter debates. They care about securing input material. If industrial users begin accelerating procurement during macro uncertainty, they don't announce it. They quietly secure supply. Quiet supply tightening plus loud paper volatility is an interesting combination. Now let's introduce another layer, collateral dynamics. Gold in particular is used as high-quality collateral in certain financial transactions. In stressed environments, demand for high-quality collateral increases. If gold demand increases as collateral preference shifts, futures markets can feel tighter even if spot pricing appears stable. That's subtle. But subtle changes in collateral flows often precede visible price acceleration. Now think about silver. Silver doesn't serve the same central bank collateral role as gold, but it serves a critical industrial and monetary hedge role. And because silver's market is smaller, any incremental shift in positioning has amplified impact. Which brings us back to the breakout levels, $100 silver, new all-time highs in gold. Those levels are not just psychological, they are trigger zones. Modern funds operate on systematic models. Breakout confirmation triggers reallocation. Trend-following systems add exposure. Volatility-adjusted portfolios increase weight. All of that happens automatically, which means if structural tightening inside LBMA and COMEX coincides with breakout triggers, acceleration can compound quickly. Now let's address something most people misunderstand. When metals break out, they rarely move smoothly. They spike, they pull back, they spike again. They frustrate both bulls and bears. That's because leverage unwinds and builds in waves. Short covering fuels the first leg, momentum fuels the second, FOMO fuels the third. By the time mainstream headlines catch up, most of the move is already in motion. Now ask yourself, why would exchanges adjust margin requirements or reporting frameworks during quiet times? They wouldn't. Adjustments usually follow volatility, stress, or anticipation of increased activity. Exchanges are risk managers first. They don't want disorderly markets. So if margin tweaks or inventory shifts are happening now, that suggests awareness of potential volatility windows. Not guaranteed explosion, but elevated probability of movement. And elevated probability is all professional capital needs. Now consider the macro backdrop again. Debt ceilings debated, energy markets unstable, regional conflicts simmering, trade relationships evolving, monetary policy constrained. That's not a collapse scenario. That's a tension scenario. Tension increases hedging demand. Hedging demand increases metals participation. Participation increases liquidity. Liquidity increases volatility amplitude. Volatility amplitude tests resistance. Resistance breaks when amplitude exceeds expectation. Now let's talk about expectation. Expectation in markets is everything. If everyone expects calm, volatility shocks harder. If everyone expects breakout, fake outs are common. Right now, sentiment in metals is mixed. Some believe breakout is imminent. Others believe rallies are overextended. That division creates fuel because divided positioning means stops cluster on both sides. Clustered stops create liquidity pockets. Liquidity pockets create sharp moves. Sharp moves force repricing, and repricing shifts trend perception. Now, here's the part that really matters. When LBMA and COMEX activity draws attention, it often means insiders are watching positioning closely, and insiders watch positioning because positioning determines pain. Markets move toward maximum pain. If too many are short near breakout levels, upside squeezes intensify. If too many are long with weak conviction, downside shakes occur before continuation. The recent behavior suggests both sides are being tested. That's classic pre-breakout behavior. Now imagine this sequence. Gold pushes to new highs. Silver approaches $100. Open interest remains elevated. Physical premiums remain steady. Margin increases slightly. Volatility rises. Breakout occurs. Shorts cover aggressively. Open interest drops as positions close. Price accelerates. Then consolidation at higher level. That's healthy breakout mechanics. Now imagine the alternative. Gold tests highs and fails. Silver approaches $100 and rejects. Margin rises. Longs liquidate. Open interest drops sharply. Price retraces deeper. But if physical demand remains underneath, the retracement becomes base building rather than collapse. That's accumulation. Either scenario involves volatility, and volatility is increasing. That's the key. The system is active, not dormant. Now think long term. Metals markets have been consolidating gains for years relative to currency expansion. Money supply expanded dramatically over the past decade. Debt expanded. Asset valuations expanded. Gold and silver moved, but not proportionally to debt growth. That divergence represents stored potential. If confidence in monetary policy wavers again, metals can reprice rapidly to close that divergence. Structural updates from LBMA and COMEX suggest we're entering a more active phase. Not sleepy sideways drift, active phase. Active phases are where long-term holders see reward, but they're also where weak hands get shaken, because volatility increases before trend clarity emerges. Now let's talk about narrative control. Mainstream coverage rarely explains futures mechanics. They report price, they don't report positioning. They report daily movement. They don't report structural tightening. That information asymmetry favors informed participants. But you don't need inside access. You just need to watch the right metrics. Inventory flows, delivery notices, open interest into key months, margin announcements, central bank purchase data, energy price trends. Those are the real-time clues. Now here's the psychological anchor. If you own physical gold and silver, your risk profile differs from leveraged futures traders. Physical holders are not subject to margin calls. They are not forced to liquidate during volatility. That stability allows you to view structural tightening as opportunity rather than threat. Futures traders must manage leverage. Physical holders manage conviction. That distinction is crucial during active phases. Now let's project forward. If macro uncertainty remains elevated and metals begin testing highs repeatedly, resistance weakens. Each test removes sellers. Each dip that fails to break structure builds confidence. Confidence attracts capital. Capital builds momentum. Momentum builds headlines. Headlines build participation. Participation builds trend. That's the life cycle. We may be approaching the transition from quiet consolidation to active trend extension. LBMA and COMEX signals suggest increased sensitivity. Sensitivity means faster reactions. Faster reactions mean larger swings. Larger swings mean more attention. And attention is the fuel that pushes metals from niche hedge to mainstream allocation. Now ask yourself one final thing. When structural signals emerge quietly, do you wait for confirmation after price explodes, or do you understand the pressure before release? Because once release begins, entry windows narrow. The huge update is not doom, it's readiness. The exchanges are ready. The system is alert. Volatility probability is rising. And metals thrive when volatility shifts from suppressed to active. Gold and silver don't need chaos, they need tension. And tension is building quietly inside the plumbing before it shows up loudly on the chart. Watch the structure, because when structure tightens under macro stress, price doesn't drift, it expands. And expansion phases are where long-term positioning pays off. Stay focused, because this phase is not about predicting collapse. It's about recognizing compression. And compression in metals has historically led to only one outcome: release.